Hey there, Brett here with Quarter Properties, your Myrtle Beach area real estate expert. And today I want to hop on here and just chat with you for a little bit about the whole 50-year mortgage that is the idea that's being tossed around and talked about a lot right now. And I just want to kind of chat about that with you and talk about, who wins in this scenario. It's being talked about because of homeowner affordability. Obviously, we're hearing a lot about the challenges of affordable housing. So this is being talked about as maybe a potential solution to the housing cost crisis that's going on in the country. So we're going to go through and dig into some math for a second, just to look at the differences between, say, a 30-year and a 50-year. But before we dig into that, just know that about 60% of all homes are purchased with mortgages. So about 60%. And of that, about 78% of those are on 30-year fixed mortgages. So people are and do take advantage of that longer term loan. Okay. I mean, they could do 15-year, but a lot of folks, for affordability reasons, they're doing 30-year loans. So that's about 47% of all homes are purchased with a 30-year mortgage. Okay. So about 47%. So let's take a look at it. The average cost of a house right here in our area is $375,000 for a single family home. Okay, so let's look at the example. Okay, if this is considering affordability, let's take a $375,000 home. Let's say you put 20% down on that. You're going to be financing, $300,000. Let's say your interest rate is 6%. Well, your monthly payment on that is going to be about $1,800 a month in just principal and interest. Okay, that does not include your taxes and your insurance. All right, but principal and interest, you're $1,800 a month. Well, where a lot of folks get into some issues with is the whole debt to income ratio. So when you look at that, like, okay, well, hey, if we've got 50-year mortgages, that's going to help out on the monthly payment, and thus your debt to income ratio, it give you some more room there to be able to afford a property. Well, if you were to do a 50-year mortgage on this same $300,000 loan, you would have a $1,579 monthly payment. So that would be $221 less. So it would definitely, potentially help you purchase that property if you were bumping up against your debt to income ratio at the $1,800 a month. Okay. So let's look at the next thing we want to look at is, the interest paid. Okay. So let's say you kept this house for 30 years. All right. You put down $375,000 house, you put down 20%. So you finance 300. So over that 30 years, you'd pay back your 300. And you'd pay an additional $347,000 in interest to the bank. Okay, so the bank likes you. They definitely like that when we do that. Now, let's say it's a 50-year loan. You'd pay your $300,000 in principal back, but you would also pay about $633,000 in interest. Okay, if you actually kept a house for 50 years, all right. So that's almost that's right around $290,000 more in interest that you would pay for that home. Now, let's be honest. Are people really going to keep a house for 50 years? Okay, the average home kept in the U.S. is around 12 years. Okay, the average home. Now, in some of your urban areas, they're kept longer, but the average in general across the country is 12 years. Okay. So when you look at that, let's say you have that 30-year mortgage, all right, and you keep that house for 12 years, okay? That $300,000 principal balance is now down to $238,000, okay? So you paid off $62,000 in principal balance. Let's look at the same example on a 50-year loan. So on a 50-year loan, let's say you sold after 12 years, your principal balance will be $289K. Guess what? During that 12-year period, you only paid $11,000 towards your principal balance. All right. That'd be tough to take. Okay. So with a 50-year mortgage, who wins? Who's the winner? Is it truly making housing more affordable? Well, let's look at it. Two of the primary benefits of owning a home, okay, are number one, you can gain equity in your home, okay, and you can participate in appreciation, and you can build wealth in that home, okay. So that's one of the first primary benefits. A second primary benefit is to stabilize your housing cost, okay? Like this is really important, especially for folks on fixed incomes. You know, if you're retired and you're living in an apartment and every single year they're trying to raise your rent by 3 to 5%, well, then your housing cost is not stabilized and it becomes very challenging to kind of budget each year. So a second primary benefit of owning your own home is to stabilize your cost of living, okay? So those are two of the primary benefits. Well, are either one of those met with a 50-year mortgage? Well, when you look at gaining equity, well, you know, if you have a 50-year mortgage and you're in the house 12 years, you've only paid down $11,000 of your principal balance. So that's not a huge benefit there. Now, if the house is appreciating while you're in it, then you can gain equity there. But yes, a primary benefit would be stabilizing your cost of living. Again, especially if you're retired. Hey, you're probably not going to live in that house for 50 years, right? But at least you know what your housing cost is going to be every single month, and pretty much can guess each year if you lock that in, okay? So, but in general, the question is, will it make housing more affordable? I got one word answer for you. No, it will not make housing more affordable, okay? And this is why I believe that. The affordability, the pricing, it's just a function of supply and demand, right? If there's more supply of buyers than sellers, then guess what? Prices are going up, okay? And the true is opposite as well. If there's less buyers than there are sellers, then prices are going down. Well, what this does is it's an influx of money all of a sudden for some people who may not have been able to afford to buy a house. Well, now they can get a 50-year mortgage. Debt to income ratio works, and now they can afford to buy a house. Well, that's an influx of some potential buyers. Well, what does that do to the price of the houses? It goes up, okay? Same thing has been true with everything we look at, whether it's food cost, childcare, healthcare, college educations, housing right now. Anytime there's influx of money through subsidies or whatever it is, the cost always goes up, okay? So it is not going to be making housing more affordable, in my opinion. So who's going to win? Well, here's what I know. If you keep that house for 50 years, or however long you keep it on a 50-year loan, the bank definitely wins because pretty much most of what you're paying is interest, okay? So the bank definitely wins there, but I really think the biggest winner is going to be the real estate investors who currently own property, all right? So if you have a portfolio of properties and all of a sudden there's a new influx of money in, a higher supply of buyers, guess what's going to happen to your average value of your homes? They're going to go up. So, and that'll be particularly interesting for folks like institutional investors like a BlackRock who owns a big portfolio of properties. So I do know this. Those folks will definitely win. Okay. So what are your thoughts? Do you think a 50-year mortgage is good or bad? Drop your notes down there in the comments. If you like this video, please click the like button. If you want more interesting tips on real estate and or the Myrtle Beach area real estate market, please subscribe and check out the details in the link below. You'll have some great ways that we can help you today. We'll be talking to you soon.